Hello trade pros. In today's video, I'm going to talk to you about creating a professional risk management strategy for your trading needs. In today's video, we're going to talk about deciding how much risk you want to take on any given trade and how to incorporate that into your overall strategy. So let's get started. The method I'm going to teach you today is called the percentage of your account balance method. The reason it's important to manage risk is because you want to be around for the long term. And the only way to be a successful trader is to be a successful risk manager. There's a saying in trading that there are old traders and that there are bold traders, but there are no old and bold traders. And I strongly believe in that philosophy. The only way you're going to be around for a long time and be consistently profitable and do this thing for a living and do it professionally is by managing risk on a trade-by-trade basis and have an overall trade risk management strategy. So let's build your very own in just a quick 4-step process. Before you begin, you want to know what percentage of your account balance you're willing to risk on any single trading opportunity. I would recommend going anywhere from 2 to 3% and 4 at the very most as you're beginning as a new trader. So choose a number and stick with it, and let's do this calculation together. For the remainder of this video, I'm going to use a 3% risk of the total account capital on a trade-by-trade basis. So let me take you through the 4 steps and go through a concrete example of how to apply this risk management strategy. Alright, step number 1. We're going to assume that we're only risking 3% of our account balance on any given trade. For today's example, I've selected an account balance of $10,000 to start day trading or swing trading in the market of your choice. That means that if we start with $10,000 capital and we multiply it by 3% risk per trade, our total risk capital per trade is $300. This is where traders get confused about position sizing. Often new traders will say, am I only risking $300 per trade, or am I only spending $300 worth of money in order to get into the trade? And the answer is that the $300 just represents your risk capital portion. What determines your position sizing from here is the next 3 steps that I'm going to take you through. Step number 2, decide where you're going to place your stop loss for this trade. For this step, you could use things such as technical analysis, order flow, volume analysis, and depending on the market that you're trading, the time period that you're trading it at, and your strategy, the stop loss placement will differ. So in this step, assuming that we have a stock that's trading at $30 and we're planning to buy this stock at a $30 entry point, we set our stop loss at $29.50. What does this mean? This means that we're only willing to risk 50 cents per share on that one position. If the price drops below $29.50, we want our stop loss to activate and kick us out of the position because it no longer represents a good opportunity to hang on to. So this stop loss is our exit point in our strategy. The second step is to determine that exit point and calculate it by taking your entry point and subtracting where your stop loss is going to be. In this example, we get a calculation of 30 entry minus $29.50 for a 50-cent stop loss in total. That's the end of step number 2. Now let's move forward. Step number 3, position sizing. One of the most important aspects of your trading is that you don't decide how many shares you're going to buy of a stock company or a product or how many lots you're going to buy of a currency. That is decided by the percentage of your risk capital that you're willing to take on any given trade. So position sizing is actually a determinant of your risk management strategy overall. Here's how you calculate your position size. In step number 1, we decided that we had $300 to risk per trade. In step number 2, we decided that for this fictitious trade, we were willing to risk only 50 cents per share before we get stopped out and move on to another trade opportunity. In step number 3, now we decide how many shares are we actually going to buy based on these first 2 steps. Here's the math behind it. We said that we had $300 of risk capital. So if we take our $300 risk capital per trade level from step number 1 and we actually divide it by the dollar amount of risk per share based on the price of our security, we get the total calculation of how many shares we're capable of buying. In this example, it works out to be 600 shares as we take the $300, divide it by 50 cents, and that gives us the total position size that we are able to get in. Now, if you guys remember, the stock that we're using for this hypothetical example is actually $30 a share. Therefore, $30 a share times 600 shares gives you an amount total of $18,000 of capital to get into this position. The reason I chose this example is it gives you an idea that despite the fact you're risking a very small percentage per trade, you're still able to use a large capital pool or a large capital base to accumulate a large enough position to make money if you're right in your trade. And this is the benefit of this strategy. In the example given here, you're not able to actually buy all 600 shares because your account is only $10,000 and the required amount is $18,000. What do you do in this example? Well, you could always scale down the position that you're taking, or you could increase your stop loss and take a little bit more risk in favor of a higher return, which could also mean you have to hold the position for longer. Step number 4 of your risk management strategy is to answer a few questions about yourself and how you plan to trade, plus how much capital you plan to risk in this endeavor. Here's a few questions you should ask yourself and write down the answers to and keep them handy every single trading day as part of your risk management strategy. How many positions will you be able to hold open at the same time? Personally, if I have more than 2 to 3 trades, I get distracted and I find it harder to follow and track along with each one of them. Question number 2, what is the maximum amount of weekly drawdown that's acceptable to your strategy? This is a percentage of what your account balance is, and if you lose this percentage on a weekly basis, you're no longer allowed to trade. This rule will help you be very selective of your trade opportunities and prevent you from overtrading. I would recommend using no more than 3 losing trades consecutively if you're using a 3 percentage point risk per trade, because that's 9% of your account balance. And if you lose 9% in one single week, there's a good chance that what you're doing is just not working, and it's worthwhile to reset the following week so you have a chance to work with that 91% remaining in your account balance and make a comeback in trading. Another question I would ask is, what is the maximum monthly drawdown you're willing to accept in your trading strategy? This is once again a percentage of your total capital and balance, and it asks the question, at which point will I stop trading for the month? I would recommend going no more than 15% of your account balance, because if you're risking more than that on a monthly basis. And the last question in your risk management strategy of step 4 is, what is the maximum amount of drawdown you're willing to accept before you just say to yourself, hey, this is not working out. I need to stop, reevaluate, create a new strategy, do some back testing, learn a little bit more about a different market, maybe switch to a different market, switch strategies, get some psychology training, whatever it might be. But at what point do I have the maximum drawdown and I call it quits and I go back to the drawing board to redesign my entire approach? This is a way of setting yourself a trading stop, but not on a single position and overall. While nobody aims to be there, if it does happen, it's good to know at what percentage point you're going to be kicked out of your trading strategy and you have to stop and reevaluate. So remember, you could be a bold trader, but you won't be an old trader. Take care, guys. I hope you've learned a lot from this video. Please put any questions or comments you have below and I'll answer them personally. And I'd love to hear from you. Let us know what you want to learn about and we'll create the education for you. So that's it for today. Please like, comment, share, and subscribe. We got a lot of awesome stuff coming your way. Take care and have yourselves an awesome day. I'll see you in the next video. Goodbye.